we've got with us Mr. Kumar Subbiah, the CFO, joining in on the show right now. Mr. Subbiah, great to have you today on ET Now. Thanks for your time. And I have to start off with the raw material costs, which are guided to rise another 8 to 10% on a sequential basis before easing in the first half. Does that mean that the Q2 margins have bottomed out, or you think is it indicating that the first July price hike is going to offset most of it?
No, good morning, first of all. Thanks a lot for having me on your show. Raw material cost continues to increase. I know crude has corrected a bit in the last 4 weeks from $100 to $110 level to around $75 to $85 level, while natural rubber prices is at 15 plus years high even today as we speak. Yesterday, the domestic prices were around 280 rupees per kg. As we go into Q2, we expect raw material prices to be higher than Q1 in the range of about 6 to 7%. We have been taking price increases in a staggered manner since middle of March onwards. The price increase that we took in July beginning would partly offset the gap, but not fully. So we have plans to increase our prices further in the next 2 weeks of the month, as well as some more increases planned in the month of August.
But you flagged off 2 more rounds, right, of about 4 to 5% each. Do you think the market can absorb that, or would there be a volume impact perhaps?
As of now, we are still seeing steam as far as demand is concerned, continues to be robust. And there is an optimism in terms of overall automobile sales at the OEM side as well. You would recall, a GST drop last year brought down the prices of most of the automobile original equipment manufacturers' output as well as ancillaries like us. So from our side, we still see market absorbing the cost. Largely, we are passing on some amount of cost and not all the cost. So therefore, we look forward to market absorbing it, going by the demand that we are seeing today.
Mr. Subbiah, hi, morning, Sajid here. You had guided for a double-digit growth for FY27 with the kind of price hikes which are coming in. Do you think, at some point in time, the demand will get moderated?
Okay, in Q1, year on year, we grew by about strong double digits, around 18.5%. So based on the demand and based on how we see in terms of the impact of price increase on tires, we are optimistic with respect to double-digit kind of a growth. Last 3 years or so, we have been growing in double digits. In the previous 2 to 3 years, large portion of the growth came through volumes. In the current year, we expect the growth to be in the mix of, we'll have a combination of both price growth as well as volume growth.
And how do you look at your international operations? What kind of growth do you see there in that market?
The international market continues to grow strongly. Second half of last year, international market, I'm talking about what we produce in India and export, grew in excess of 20% in the second half of last year. Even in Q1, we had a mid-teen kind of a growth in Q1. We have enough orders in the pipeline. However, we are facing some pressure in terms of our ability to take the prices up in line with raw material costs in the international market. Otherwise, demand for our products at a reasonable price level continues to be strong.
And give us a sense, therefore, you've undertaken some price hikes. You've seen cool off in raw material prices. You've suggested that Q2 margins should be better. You've guided for a better H2, but the presumption seems to be that Q2 itself margins will improve quite sharply.
We don't expect Q2 margins to improve sharply because in Q1, the raw material cost, at least our cost of goods that we produce for sale, did not reflect the entire increase in the raw material cost. Okay, so as we carried inventory in the form of raw materials and finished goods just before West Asia war broke, okay, so that impact was certainly there in the month of March and in the first half of the Q1. As I mentioned earlier, we expect raw material costs to go up by another 6-7%. By end of the quarter, because the price increases are happening in a staggered manner, okay, and by end of the quarter, we look forward to exiting the quarter maybe at a higher realization level with large amount of input costs being recovered. But margin point of view, we don't expect a sharp improvement. While look forward to some improvement, but not a sharp improvement.
Kind of inventory management that you're doing at this point in time, given that raw material prices are volatile, have you reduced the inventory holding because of that?
In quarter one, from March onwards, we took an approach to ensure that all our factories don't run out of raw materials, because it was not only an input cost increase that happened during the West Asia war, but there were also supply disruptions. We have a large dependence on imports. Okay, even the local manufacturers had challenges in terms of inadequate availability of gas and other materials required for the purpose of production. So we maintained at a higher physical inventory during quarter one. We will continue to be cautious. We would, while we'll bring down the covers, but we'll operate with slightly higher physical inventory so that our factories run and there's no supply disruption point of view. And crude related, crude derivatives related raw materials, we are at the mid end of the normal covers, considering a drop in crude oil prices, but natural rubber prices continue to be high. So we will operate at the normal level going into quarter two, with a clear focus in terms of availability of materials in all our factories to avoid any production disruption.
What is the current level of gross debt that is there? And you have spoken about a capex of 1250 crores. So how are you going to fund that?
Gross debt moved up by about little less than 100 crores during the quarter. We incurred about close to 300 crores, 295 crores of capex in quarter one. Large part of the capex we were able to support from internal cash accruals. And in the current year, our capex outlook is still about 1300 to 1400 crores for the year in terms of cash flow. So from our point of view, there could be some increase in debt, but not very significant. In quarter one, our working capital also moved up by about 100 crore in value terms. Also on account of the fact that I just mentioned about holding a slightly higher physical inventory. So once the margin normalizes, which we hope will happen from quarter three, in terms of raw material costs remaining constant or stable, okay, we hope our margins should be better and we will be able to generate adequate cash. But we'll be very cautious, in terms of managing our overall debt level. We'll operate within our stated, overall leverage framework. It will be in the range of 1.5 to 2 debt EBITDA is the level at which we would like to operate during this period.
And you'll be able to maintain the 3,000 odd crores of debt levels which is there, because what we are seeing is a bit of increase in your finance cost which is coming in, which is putting pressure on the PAT as well.
No, finance cost on a standalone basis, there has not been much increase. If you really look at it a year-on-year basis, of course, we had to fund for our acquisition in quarter two last year towards Camso, and therefore that has now become part of the baseline debt number. At a consolidated level, about 48 crores of finance costs that we have reported is largely on account of currency depreciation in Sri Lanka. Okay, Sri Lanka has a debt in their books, okay, in dollars, which has been given by CEAT India. Okay, so because of sharp depreciation of Sri Lankan currency in quarter two, while rupee remained the same, more or less stable within a range from beginning of the quarter to the end of the quarter, that impact is part of the finance cost in the consolidated numbers. So we don't expect that to repeat. We are taken on yesterday, the board approved us to, in terms of taking up converting some part of our debt in the books of Lanka Camso entity into equity and making our debt equity about a 1:1. That should impact favorably at the entity level. But overall point of view, we don't expect the currency to swing in the subsequent coming quarters as it happened in the previous quarter.
How is the Camso integration going? Because it's little slower than expected. And by when do you expect the integration to align your margins as well?
No, integration is happening as we speak. Okay, and there are two important steps in this integration. In addition to taking over the entire manufacturing operations, one is that taking control over the customer's part. Okay, and Michelin and Camso continue to support in terms of servicing the customers because we had to create infrastructure overseas and also engage with customers in terms of transferring all the servicing related and supply related requirements. As of end June, 50% of the customers we have started servicing. We look forward to that number going up to 90% by end of current quarter, by September. And in the subsequent quarter, 100% of the integration with respect to customer servicing, infrastructure, all of that would get completed. As far as the manufacturing integration is concerned, we expect that to happen in quarter one, quarter two. The local Michelin Camso entity continues to supply us compound, okay, and we are in the process of having our own upstream equipment in the form of mixer and calendar. That we hope it will get completed in quarter two of the next quarter one of the next financial year. And by then, I think most part of the integration would have happened.
Yeah, it was a pleasure talking to you today and getting your perspective on the operations. Thank you very much for joining us on ET Now.